Thank you for joining us. We are recording this, so we post these to our YouTube channel, and we get a lot more hits in recordings than we do live, but I guess that's the way it goes. um, so today we're going to talk a lot about refinancing and the things that people should think about when they're refinancing. And one of the things I'm going to talk about is there are loan officers and lending companies that are, in my mind, they're not putting the client's best interest first, and they're just trying to close deals. And we're going to show you how they do that, and they make it sound so great. Oh, we're going to save $500 a month. And what they don't say is we're going to add 10 years to your mortgage, and so you're going to end up paying, hundreds of thousands of dollars more on your mortgage. So those are important things to watch out for. Is not doing what seems good, but what is in your financial best interest, and that may mean you should not refinance your first mortgage. But that's important management of your property and your equity and what you're trying to accomplish financially. So we are going to kind of show you what not to do, and a lot of times there are loan officers out there that are going to try to talk people into refinancing when it's really not either the best program for them or it's not in their best interest. So just try to give you some parameters on how I look at things and when I believe that the refinance of your home makes sense. And I do it from a financial point of view. I'm strictly finance. So let's just get started. I'm going to kind of go into, I might as well start with a little bit about my background. So, I've been in the business in Hawaii for 23 years now, going on 24. And all that time I've owned a mortgage company in Hawaii. I do have a master's of science in economics, and I have an MBA in finance. So I know a little bit about what I'm talking about. And I've closed over 1.5 billion in residential, business, and commercial loans. So I do a little of everything. But residential is the bulk of it. I am now licensed in Hawaii, California, Colorado, and I think Texas was just approved, but if not, it will be in a few days. So if you have any family or friends in any of those states, we would love to have a referral. And I am from Colorado, so I've done a lot of loans in the Aspen, Vail area, and I think I hold the record for the largest loan in Aspen at 35 million. That was a long time ago, back when 35 million was a lot of money. But anyway, so share my contact and share Alex's contact too. Okay. And Alex would put her contact information in the chat box just to make sure that you have it, and mine too. So what we're going to talk about is, I call it strategic home ownership, is really managing the financial potential of your home. I mean, your home is really the biggest financial instrument you'll ever manage, and it should be treated like that. It's an important aspect to your wealth. We're going to talk about the key benefits of lower rates, lower payments, what kind of loan types to look at, and then other financial strategies that you can employ to make the equity in your home work for you. And you get in some pretty crazy numbers about simple things you can do to improve your financial situation. And then we're going to talk about, there's refinancing just to get better terms and rates or a different loan type. And then there's refinancing to get money out. And that's tapping into your home equity and trying to put that equity to work. And we're going to go through some of the common uses of cash out refinances. And I think Anthony was talking about one of the things that he's interested in doing is building ADUs or additional homes that can generate revenue. And then we're going to talk about how do you determine if you should refinance, because again, you talk to loan officers and they want you to refinance if they can save you $200 a month, but is that really in your best interest? And then we'll kind of go in the next steps of what you need to do if you're interested in refinancing. And I do ask that if you want to ask questions, you can just unmute and ask questions, or put them in the chat, and Alex will interrupt me. And so we prefer to see the questions when we have the slide up, but you can save them to the end too. So, okay, so let's talk about strategic home ownership. So you have to always consider your home as one of the most important financial investments that you own. It has to be managed. And a lot of people will buy their home and they just got a 30-year fixed mortgage and they just leave it alone. And that's okay. But there's a lot that you can actually do with the equity in your home to improve your financial, the growth in your net worth and your financial health. And as you probably know, that most Americans accumulate a majority of their wealth through home ownership, whether it's one home or multiple homes. Maybe you have an interest in being a landlord. I mean, that's where the money is really made, is being an investor in real estate. And real estate is probably the number one investment tool to make the highest rates of return that is stable and predictable. Certainly you can buy Bitcoin and you can buy these other investment opportunities, and if you hit, you're great. But real estate is predictable, and you can generate at least a 20% rate of return if you do it right. And so we're going to go into that. So right now, if you can believe this, there's an estimated almost $36 trillion in U.S. home equity, earning a grand total of a 0% rate of return. Now, would you go to your investment advisor and say, hey, I got $36 trillion. I want you to manage it for me. I don't expect a rate of return on it. Well, of course you wouldn't. But that's what a lot of Americans are doing today and there's reasons for that. I mean, not everybody can tap into their equity because they're limited in their ability of what they can afford. But there's a lot of people sitting on equity that could be working for them. And again, it generates a 0% rate of return. Your home will go up in value every year. And on average, it's about 4.9% per year over the last 70 years. So over time, you should expect at least a 4.9 to 5% growth in the value of your home every year. Some years are bigger, some years are lower. And so it's going to go up in value regardless of what you owe on that property. So if you have a lot of equity in that property, that equity generates a 0% rate of return. So that's important to understand. It is an investment, and it is generating rates of return that, if you pull that equity out, you can do something better with it. Again, you are limited to what you can handle personally in terms of monthly payments, and that can be augmented also. If you look at the homeowners over 65 years of age, they have over half, or just about half, of the entire equity owned in residential real estate in the United States. So it's the baby boomers. The baby boomers have 17 trillion in home equity, and that's coming to roost, by the way. I mean, we are seeing the aging of the baby boomers, and a lot of them are not going to stay in the homes that they're in, and they're going to be doing something with that equity. And some of them do pass away, and so that money will go to their heirs. If you look at Hawaii, the average tappable home equity for the average homeowner in Hawaii is almost $500,000 per homeowner. So they're sitting on $500,000. The average homeowner in Hawaii is sitting on nearly $500,000 of money that they could be investing. And I'm not a financial advisor, but I do know numbers. And, there are some things that you could be doing with that. So think about where the current rates are. As Anthony was talking earlier, we did have the Federal Reserve lower short-term interest rates a quarter point last week or this week. Now, did that have an impact on mortgage rates? Not directly, no. What the Federal Reserve did say is that at the end of December, they're going to start buying short-term treasuries to the tune of $40 billion a month. That affects mortgage rates. So we are hoping to see some movement in the decline in short-term treasury rates, which should help affect the 10-year treasury, which mortgage rates tend to follow. But right now we're roughly, depending on your FICO score and what you're doing, 6% on the 30-year fixed. We're below 5.5% on like a 15-year mortgage. And the 7-year and the 5-year ARMs are in the 5.25%, 5.5% range. So these are good rates. Historically, these are below the normal interest rate for mortgages across time. Certainly, we got spoiled when we had 2% and 3% mortgage rates, but right now they're low, and they're going to start, I think, inspiring movement in the real estate market. So people that might have a 4% mortgage and they've been sitting on this house, they want to move closer to the grandchildren. They want, the grandchildren are in Paris and they want to go to Paris and live next to the grandchildren. That now we're getting close enough where they may, I'm going to give this house, I'm going to sell it, and I'm going to move. So we're starting to see some of that. So people are going to give up a lower rate mortgage just because it's time for them to do something different in their lifetime. Okay. So what do we mean about refinance? I mean, there are different aspects to refinancing. I mean, the most common thing is you just replace your current mortgage. And why are you doing that? You're going to do it because you're going to get terms that are better for you, that suits your financial objectives. It might be a lower interest rate. It might be that you want to shorten the length of the mortgage so you can pay it off faster. You might be lengthening the amortization on the mortgage so that you lower your payment substantially. But refinancing also means obtaining a home equity line of credit, leaving your first mortgage alone because it's got a good rate, and getting a home equity line of credit or second mortgage so you can tap into equity. And you can tap into equity for hundreds of reasons, but we're going to go through a few of those. So normally people are refinancing to improve their rate and term, shorten or extend an amortization period, or to get money for other needs and investments. And again, there's so many reasons to pull cash out of your home if you can afford the payment. So the process is the same as when you bought your home. You submit an application to us. We go through underwriting. We may or may not need an appraisal if you're not pulling out, 95% of all of the equity. We may get an appraisal waiver that can cheapen up the cost of a refinance, and then we go through closing. So that's normally a 30 to 45-day process. Now, if you look at Hawaii, and again, because our homes are so much more valuable, that the average Hawaiian homeowner, like we said, has $500,000 in equity that they could tap into. Now, you can't borrow all of your equity unless you're a veteran. So a VA loan, you can go to 100%. You can pull all of the equity out. But normally you can't do that with conventional. You generally don't want to go above 80% loan to value, leaving 20% of equity in your home. You can go to 95%. with conventional loan. And conventional loans in Hawaii are roughly at $1.25 million, $1.25 million. But as you can tell, that if real estate goes up 5% nationwide, I'd rather have a home in Hawaii going up at 5% than maybe a home in Alabama going up 5%. So we do benefit, although it is higher cost of living. People are generating a lot more wealth in Hawaii than they do in other states. So that's a benefit of living in Hawaii that some people, I think, forget about, is the amount of equity we're generating in real estate. Okay, so I want to talk about where mortgage rates are right now. So this is the Fannie Mae 5.5% bond, and it trades every day, and I watch this every day. And we are now right here hitting a 2-year low. We're almost there. We've nicked it a couple of times almost, but we're going to be there, I think, very shortly at a 2-year low. And again, on the bond, as the price of the bond goes up, the yield goes down. So the higher the price, the lower the rate, and that's what we're looking for. So I think we're going to be breaking this here at the beginning of the year, as soon as the Fed starts buying treasuries. So we're going to kick off 2026 in a pretty good place. Now, what will drive it past that is going to be, Chairman Powell is going to be replaced at the Federal Reserve. My guess is Trump is going to pick somebody more dovish that wants to lower mortgage rates, because rates affect home affordability, and that's a big deal for President Trump, whether you like him or not. I mean, that's a big deal for his policies. I think that rates will stay in this area. I think we're going to be in the fives, no matter what we do in 2026, maybe 2027. There's things outside of the Federal Reserve that could affect rates, with any turmoil in the world markets. World interest rates are going up a little bit, and that can have an impact. Japan has been increasing their interest rates. This is all going to play out. But my guess is we're going to have an easing of the Federal Reserve's policies, and we should stay in a pretty good place on mortgage rates. I don't see a substantial drop, but you never know. But I don't see a substantial drop. I think we're going to be in the fives for all practical purposes, whether you are on an ARM or a 30-year fixed or a 15-year fixed. We should be right around that 6 or below in the fives. Okay, talking about reasons to finance, well, easy. If you can lower your interest rate and reduce your payment, do it. I mean, if you have a 7.5% interest rate on $1 million mortgage, and we could drop it to 6%, we could probably even go lower than that. I mean, you're basically saving yourself $1,000 a month. So these are big numbers for a lot of people that have mortgages, and they shouldn't be just sitting watching $1,000 slip away. But the thing that I point out to most everybody I talk to is, do you want to start your amortization over again? So let's say you've had your mortgage for 5 or 7 years, and you've got 25 or 23 years left on your mortgage. It sure looks nice to refinance that and get a $59.95 monthly payment. But do you really want to start the clock over again? And that's where I think most loan officers really don't advise properly. And you can get any amortization period you want. If you want a 23 amortization period, I can do that. So I don't like starting the clock over. I like interest rate savings. And so I always do my analysis on how much interest are you saving every year. Forget about the payment for a minute. Let's talk about interest. If you're saving interest and you can pay back the cost of refinancing pretty quickly, then it makes some sense. Other people have mortgage insurance. Let's say you bought your home and you borrowed 95%. You can remove mortgage insurance by refinancing if the value of your home has increased enough or the balance on your mortgage has decreased enough so that you're at 78%. So the savings on mortgage insurance is a big deal. A lot of people are paying $300 or $400 a month in mortgage insurance. So that can be eliminated. And mortgage insurance doesn't do anything for you. It's not insurance. It's not interest. It's just money being paid out to give an investor an insurance policy that you get no benefit from. So again, another reason to refinance is to modify your amortization period. Maybe the drop in interest rates will allow you to drop into a 15-year fixed rather than the 30-year fixed. You can also switch to an interest-only payment. Let's say you've got some other things coming up, like college tuition, and you really want to minimize your monthly payment. In the short term, this is better for you, just so that you can help your children through college. Well, we can do that. We can switch you to an interest-only payment, reduce your monthly payment, or we can convert from adjustable. I have a lot of people are coming in with adjustable rate mortgages where their adjustable rate mortgage is about to go up. They've got their notice, and now we can probably roll into a fixed rate loan at or below what they're going to get on an adjustable rate mortgage. So, that's a. Now, I like adjustable rate mortgages because they are lower in rate, and for a lot of people, depending on what you plan to do with your property. If I have people come to me and said, we're going to be out of here in 5 years, we're going to be moving to the mainland, or we've got some other plans, or we're going to build a new house, and we're going to have this house for 5 years. Well, they shouldn't be in a 30-year fixed rate mortgage. I mean, you're paying for something you're not going to use. And a 5-year ARM is much lower in rate than a 30-year fix. So everybody's got their own financial criteria. And that's what I love to do, is I like working with people's plans. What are you planning to do? And let's fit a mortgage to your plan. And if you can believe this, I've talked to loan officers that have only originated a 30-year fixed mortgage. I probably, in 2022 and 2023, I probably didn't originate one. And I'm thinking, okay, what am I doing differently that they're not seeing? I was doing all ARMs because we were getting crazy good rates. And there's some people that just want a 30-year fix. But if you're not going to keep that mortgage for 30 years, the lenders know you're not. They know you're not going to keep that loan for 30 years. The average homeowner keeps a loan for 5 to 7 years. And so all of the extra interest that they're charging you on that 30-year fix is just a windfall profit for the banks. And then I just heard about maybe they're going to go to a 50-year mortgage. I mean, that's just stealing money from people. That's just taking more interest on something they know you're never going to follow through with. I mean, to me, that should be illegal, in my opinion. But so I do convert people from fixed rate mortgages to adjustable rate mortgages. Again, it's a financial tool, but you got to know what your plan is. So on a cash out refinance, there's a million reasons to do this. And one of the most common things I'm seeing in Hawaii, because the counties are suggesting that people build ADUs to help solve the residential rental crunch that we're all in, is we provide the money to build an ADU. And let's say you want to build a small ADU. It's going to cost you $250,000. The additional monthly payment would be about $1,500 a month. The ADU itself will add way more than what it costs to build if you build it properly. So you're probably going to, let's say in this case, you can add $400,000 to the value of your home by building an ADU, and the revenue will more than cover the mortgage payment. So you built an ADU, you've added an extra $150,000 in wealth. you're cash flowing it, you're getting a bigger depreciation because now you can depreciate this ADU because it's a rental property. I mean, it's a great way to go. And we're going to go into an example of this. But also, people are looking for cash for their children's education, or maybe you help your adult child, become a homeowner. I mean, that's one of the best ways to take some money out of your home and give a good place to go, because on average, a person who buys a home, the money they invest in that home generally earns over a 20% rate of return. We're going to go through that. But other people are looking for cash to support assisted living or maybe some other health issues. They've got all that money tied up into their home and they want to use it to live on. You could use cash to purchase an investment property. And generally, you're going to make about 20 to 25% rate of return on most investment properties. And the reason for that is because you can leverage. You can't leverage in the stock market, but you can leverage in real estate. And if real estate's only going up 5% a year, but you only invested 20%, what's your rate of return? The rate of return is going to be over 20%. Plus, you get depreciation deductions. You get to expense things that you never got to expense before, like your car and all sorts of things. And you can also use the money to buy long-term investments. And that's one of the safest things to do, is take some money out of your real estate, park it into a retirement plan. And we're going to go through an analysis of, why you'd want to do that. Okay. So let's look at a model of, you're going to purchase an investment property. And let's say the property costs $1 million. I like round numbers. And you pull $300,000 out of your current residence to buy that property. And let's say the property's got a couple of places that can be rented out. You're going to generate about $4,000 a month, which would be about typical for $1 million property that might have an ADU or whatever else. Now, the cost to you on that home is going to be more than that at first, about $4,700 a month. But remember, you're locking in your mortgage, and over time, the rents are going to go up, and you'll eventually break even and start cash flowing. But when you first start out, maybe you're negative cash flowing $8,400 a year. But think about your depreciation deduction. You're going to get about $27,000 in depreciation deduction. Let's say you're paying in the realm of 35% federal and state income tax. So you're getting a tax savings of about $9,500 more than your negative cash flow. So you're paying monthly cash out, but you're going to pay less in tax. And so it balances out pretty nicely. But you're going to get about $50,000 a year in annual appreciation, and that will go up over time. You're going to get an average of about $23,000 in principal reduction over time. So the annual rate of return on your $300,000 investment is 24%. And you almost can't miss on this. I mean, it's truly amazing, the benefits of owning a home, an investment property. You're going from generating 0% rate of return on your equity in your home to 24%. That's pretty amazing. That's pretty amazing. And this formula is almost unbreakable if you buy the right property. I mean, if you're buying a rental property, buy it right. I've seen people buying rental. I just have a client that's got a rental property. It has 5 renters in the property, and he's going to cash flow out of the gate. So, okay. So I missed a slide here. Hold on. Uh-oh. I missed a slide. Hold on, let me look. Well, I somehow deleted a slide that's really important. So let me just talk about money that you can take out and invest in the stock market. So let me come back here. I apologize for there's a slide that has gone missing. So instead of investing in investment property, if you took that same $300,000 out and invested in the stock market, did you know that the average rate of return for the S&P 500 over the last 70 years is like 10.75% if you buy stocks that are paying dividends? So if I can borrow at 5 or 6% and I can generate 10 to 11% in the stock market, and again, generally those are safe investments where you're buying into stocks that pay dividends, and you also get the growth in the value of the stock every year. So stocks generally go up about 8%, but you can generally make another 4 or 5% in dividend returns. So that money that you're pulling out of your residence, if you don't want to own an investment property, you can plunk into some, and again, a financial advisor would help you with this, but there are a lot of dividend companies that are paying dividends at 5 or 6%, and the value of their stock also goes up 7 or 8%. So it's kind of a no-brainer to pull out as much as you can afford. Of course, you're going to have a higher monthly payment on your residence, but you're benefiting at least 5 or 6%, and that's it's nothing to sneeze at. So it can really help improve your net worth and grow your net worth. And the other part of having money outside of your home is you're liquid, and sometimes liquidity can be very beneficial. Let's say there's a real quick opportunity that comes up and you've just got to jump on it. And if you didn't have the money just to write the check, you're not going to get that deal. And that happens. So people that have investment opportunities that and they're not liquid, they may miss that opportunity. It could be a foreclosure sale, it could be a lot of different things. But being liquid sometimes is very, very valuable, especially if something happens to you, you're not working. Think about the family that, let's say the breadwinner gets injured and can't work, and they've got all their money tied up into their real estate. Well, you can't go get a loan now because you don't have a job or you're not able to work. So you can't pull any money out of that home. If you had put some of that money into the stock market, into some very safe investments, you can quickly sell stock if you need to live on it. So again, liquidity is important. You shouldn't have everything in equity in your real estate. Okay, that's what the slide I missed was going to say. So the next, anybody have any questions up to this point? Okay.
I have a question about being liquid. What kind of homes? What kind of homes are considered to be liquid?
No, this wouldn't be about buying a home unless you put a home equity line of credit in place where you could draw money from it. What I'm talking about is taking money out of your real estate. Instead of buying another home with that $300,000, if you just put it in the stock market, you're going to earn more than you're paying in interest, almost undoubtedly, if you do it right. So you buy stocks that are not only paying a 5 or 6% per annum dividend, but they're also going up in value, 6, 7, 8%. But those stocks can be sold in days. So now you've got $300,000 in the stock market that is very liquid. And if anything happens, and I've seen it many times where people have all their money tied up into their real estate, and then something happens to somebody. They lose their job, they get hurt, and all of a sudden they can't make ends meet, and they go to the bank, and the bank's not going to lend them any money because they're not earning an income. So now they're sitting on all this equity in their home, but they have nothing to live on. And, and that happened in, '08, 2008, when, values went down and people lost their job, and they ended up just having to sell their home at a discounted value. If you had squirreled away some money into an investment account, you would have the liquidity to survive for a period of time, who knows how long, but it's important not to have everything in real estate. It's good to have some liquidity. Okay. I hope that answered your question. So when people come to me and say, okay, should I refinance? And it really gets down to a simple mathematical calculation. How much does it cost to refinance, and how much are you saving? So generally, when you refinance, you're going to pay an underwriting fee of $1,150. You're going to pay for an appraisal, maybe. We can sometimes waive the appraisal fee, but on a normal house, you're probably looking at $1,000, and if it's a really expensive home, it might be more than that. The escrow fee is always about $600. So the underwriting fee and the escrow fee are generally fixed. The appraisal can vary a little bit, few $100s. And then the title fee. And the title fee, that does vary based on the loan amount. So at $500,000, you're probably looking at a title fee of $1,700. At $2 million, you're probably looking at $4,300. And it's not proportional. So, if you increase the loan amount by 4 times, you're not spending 4 times as much on a title fee. Now, we don't look at other costs like the escrow costs for taxes and insurance, because you're going to pay tax and insurance no matter what you do with your home. You still have to pay that. So that's not really a cost to refinance, although money has to go into an escrow account if you're going to have an escrow account, and then you're going to get money back from your current escrow account, or you can choose not to have an escrow account. So if you look at a $500,000 refinancing, you're going to spend about $4,500. On a $2 million loan refinance, you're going to spend about $7,000. So you can borrow 4 times as much for less than twice as much in closing costs. So it's not proportional. So in order to justify refinancing a small loan, you need a bigger improvement in the interest rate. On a bigger loan, you can get a small improvement in interest rate and still justify a refinance. So let's look at how that plays out in these 2 examples. So let's say you have a $500,000 loan that you're refinancing, and you're at 7%, and you're going to drop to 6%. That'll save you $5,000 a year, which means you get your money back in less than 1 year. Now, that's a no-brainer. Now, let's say you're at 6.5% and you're going to go down to 6%. You're only going to save about $2,500 a year in interest. That's a 2-year payback. That's okay. That's about as far as I would go. So when a loan officer is giving you information about refinancing, only look at the interest savings, not the savings in the payment, because the savings in the payment could be huge because you're starting the clock over again. Let's say you've been paying on your mortgage for 10 years, and then you're going to add another 10 years of payments. Boy, it sure looks good when the payment goes down a lot. But if you're not saving the interest, it's not really in your best interest to do that unless you're really stuck and you absolutely have to get a lower payment. So the second example is showing you how a bigger loan, you can save a lot less and still justify refinancing. So in this case, okay, you got a refinance cost of $7,000. You drop from 7% to 6%. Well, you're saving $20,000 a year. You're going to pay that cost of refinancing in 4.5 months. That's amazing. Now, what if you just saved 0.25%, 6.5, 6.25 to 6%? Well, that's saving you $5,000 a year. That's a 17-month payback. That's probably worth doing. So, in example one, 0.5%, you're probably not going to want to refinance, or that's kind of the limit. And on example two, 0.25 point could justify doing a refinance. So refinancing, there's no rule of thumb. You need to really run the numbers, and that's so important. And like I said, don't be fooled by resetting amortization periods. So let's say you had a $700,000 loan at 7%, and it has a payment of $46.57 a month. After 16 years you've been paying on it, you got 14 years left, you still owe $500,000 on that loan. So for half of the loan term, you've only paid the loan down $200,000. So if you refinance at 7% and save no money, no interest rate, and refinance it, that 30-year fixed would drop to $33.26 a month, saving you $13.31 a month. Now that sounds good, but it's certainly not in your best interest, because one, you're not lowering your interest rate, and you're just extending the time that you're going to be beholden to the bank. Now, maybe you're in a situation where you absolutely have to lower your monthly payment. I understand that. But don't get talked into refinancing and resetting your amortization period without discussing that. And again, in this case, I would direct the client to a 15-year fixed mortgage. You're only adding 1 year, and you can cover that real easy. And 15-year fixed today is at 5.5%. Okay, so the payment drops to $41.19. You're saving $500 a month in real money, and it doesn't look as good as the one above, but you're not adding another 15 years or 14 years to your amortization period. So in the long run, this is a much better solution for the client. And remember, you can have any amortization period you want. If you've been paying your loan for 11 years, you can have a 19-year amortization period. And I like that with a lot of people, that at some point in time, you may want to be in a position where you're loan free as you head into retirement, and then we'll talk about reverse mortgages at that point in time. So, okay. So does that make sense, that, you just don't be fooled by the impact, the lower payment? Make sure you understand if you're resetting your amortization period and starting all over again, because that may not be in your best interest. Okay, I think that's about it. The loan refinance process is the same as, when you buy a home, you need to submit an application. You can go to our website at eMortgageHI.com, click on Apply Now, and fill out the full loan application. That shouldn't take you more than 30 minutes. Then you need to upload in that same system, when you've logged into eMortgage Hawaii and created an account, and you can log in and out anytime you want, and you can upload all of the documents that are being requested there that pertain to you. And that's a couple of hours worth of work. We need tax returns and pay stubs and bank statements. Then we will complete a financial assessment, and then we will counsel you on what your loan options are going to be, what makes sense, what you're trying to do, where your life is going, because we have to know those things to give you good advice. And then we go through the appraisal, processing, underwriting, and approval. That takes a few weeks, and then we go through the closing. So that's about a 45-day process at worst. It mainly depends on how quickly you get us the documents that we need. So, but hopefully that gave you some things to think about on refinancing. And it's important that you're working with a loan officer that is going to spend some time with you to truly understand where you're heading. And is this home going to be your lifetime home that you're never going to leave ever again? Or is this a home that you're going to need to sell and maybe buy a bigger home because you're planning to add to your family or whatever the case may be? Or maybe you've got a parent that is going to need to join you in a generational situation where you've got maybe an ADU that you're going to have for them, so that you can be close to them and help them as they need any kind of assisted living. So those are the important things that we need to understand when giving you advice. So okay, so I'm just going to open it up to any other questions you might have. Everybody have a great holiday and enjoy the next few weeks. All right.
Yes.
In January, we will be offering our forecast for 2026. It's in combination with probably the best economist in the country, Barry Habib, and he's, I think, won 4 Crystal Ball Awards, which is the biggest award you can get as an economist in the United States, and he's won it 4 times. So we're going to share his information in January about where the real estate market is heading, and where we think the mortgage rates and the mortgage industry is heading as we head into 2026. So that's always an informational one, and he hits it almost on the head every time. It's amazing how accurate he is. We do a little twist with the Hawaii information, so we bring it local and provide some additional information about the Hawaii market. But we'll be announcing that webinar in January. So
Yeah, and right,
Okay,
it's
great.
on January 17th for those guys who are
at
keeping an eye out.
11 a.m. Hawaii time. Okay.
Okay.
All right,
All
everybody.
right.
Thanks
Thank you,
again.
guys.
All right.
Thank you. Bye.
Bye.